What's going on with this little swoon we've been in, at least on these
just
bigger
a little swoon. I mean, look, I've never recalled or read about a president that has been this bullish and bearish at the same time. And as a result, we're seeing this zigzagging market where earnings are fabulous. The market wants to go up on earnings, but it gets held back by the president's protectionism. So I think we have to wait until that all sorts out.
Well, doesn't a zigzag take you to nowhere from where you started?
Not necessarily, because I think the market is increasingly coming to the conclusion that a lot of this is deal making in public. It's noise. Look, when you actually look at the tariffs, they're not a big deal. I mean, obviously, if it keeps going like this, it's not going to be good for the market. But I think increasingly the market's going to focus on the signal rather than noise and the signal of earnings.
I read somewhere that for every percentage point that short rates go up, it's something on the order of $500 billion in additional interest expense for non-financial debt throughout the economy. So household debt, consumer, you know. First of all, is that something that we need to worry about, and is any of that priced into the market?
Well, the flip side of that, of course, is everybody who's wanted to be conservative and put some money in interest-bearing short-term securities has been getting hosed. Now they're going to be making more. The other thing is a lot of debt has been refinanced for long periods of time, particularly in the bond market. I'm reading a lot of people getting very jittery about corporate balance sheets, but when you really look at it, they've extended their maturities at historically low interest rates. So I think they're not going to be hurt by that. Look, I think all we're seeing is a return to normal. That's what the Fed calls it, the normalizing monetary policy. They've been very good at communicating. I think they're aiming for 2.5%, 3%. And I think we can live with that.
Jim's made the point that the next sort of catalyst to take stocks higher, I know you think we're going higher, is going to be earnings. Are we good with slower earnings growth, though? Right? We're coming off 25% earnings growth.
Right.
I mean, the bar's been raised a lot.
The bar's been raised.
Are we good?
Well, the bar's been raised, but the reality is, as you said, since the beginning of the year, we've been going nowhere fast. So we really haven't even discounted these earnings. What we saw the PE, the forward PE, go up to about 18 at the beginning of the year. Now it's 16.5.
You're telling me you don't think it's in the market?
I don't think it's completely in the market, no, because I think we're going to see that earnings are going to continue to grow, and I do think that the PE has a chance of going back to 18, which 18 with where forward earnings are right now gets you to 3,100.
It's an interesting story today in the Journal, right? This slower earnings growth, and whether it
slower is just
tests two things to market, tests investors.
10% growth, and I've seen your numbers, and it's roughly 2019 over 2018. Maybe you'll give me this 10% growth. That is good enough to rally on from here. That's still very good. 25% is unsustainably high. We know that. The other thing to point out, we think this year's been a dog. I think you said something like that just a minute ago. Well, we're up almost 5% total return on the S&P 500, and we're not quite halfway through the year. If we did that in the second half and we were up 10, 11%, we'd say that's a good year. We wouldn't say it's a dog. We wouldn't say it's a blow the lights out. We'd say it's a good year.
I agree. There's really no reason why the market can't just grow at the normal long-term trend, which is 7%. But I don't think the 25% jump in earnings, which is a one-time jump, but it's with us forever.
You feel, I mean, it feels to me like, your target's 3,100. That seems to me to be the highest on the street.
Well,
I was certainly one of them.
I was one of the strategists surveyed at Barron's at the beginning of the year, and I was the highest back then. I felt like an absolute genius until January 20th or so, and then the market took a dive, and then, I really exposed myself with an awfully bullish number. But I'm pretty comfortable with it. The earnings are there. The question is where
what would make you change that target lower?
Well, look,
is it an event?
A lot of my bullishness in this bull market has been based on the view that inflation is going to stay down and that there's plenty of liquidity. I know some of that liquidity is coming out, but on the other hand, as was mentioned before, you got all these repatriated earnings, and earnings themselves are very strong. Corporate cash flow is at an all-time record high. The cash is so ample that they can do everything.
Right, but is there no event, though, that would make you change them? We agree that those are the conditions.
Why aren't you worried about inflation? Anything that convinces me that a recession is coming would worry me. I mean, clearly, if the protectionist saber-rattling and skirmishes turn into all-out trade war, we'll all be burdened.
But Ed, why aren't you more worried about inflation? It doesn't sound like you are. You throw it out there as a risk.
Well, I've been doing this for 40 years, and I've been a disinflationist for 40 years, so it's probably time for me to be just dead wrong.
Well, when have you seen employment as high as it is in the last 40 years?
But look, but at the same time, look, wages are still running around 2.5%, 3%. Janet Yellen back in 2014 was looking for 3 to 4% by now.
But, well, it doesn't mean it won't happen. It just means it hasn't happened yet, right?
But Steve, if you...
And what about the pressures on prices now?
A lot of those, I think, are going to be absorbed by profit margins. One of the things that's interesting is we had record profit margins in the fourth quarter before the tax cuts, and with the tax cuts, it was 11% back then. With the tax cut, we're at all-time record high of 12%. So I think some of these pressures can be absorbed in the in the profit margin.
And have those declining profit margins figured into what your estimates are for the S&P?
Well, yeah, I mean, I think we go back to 11%. I think that absorbs it.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.